Inflation. In simple terms, inflation is a rise in prices over time. Think about it like this. A gallon of milk that cost $2 last year might cost $2.50 this year. Why does inflation matter? Because it erodes the purchasing power of your money. If prices rise faster than your income, you're effectively losing money. Inflation affects the entire economy, from interest rates to stock prices. Businesses face higher costs for raw materials and labor, which they often pass on to consumers. It's a delicate balancing act, and when inflation gets out of control, it can derail the entire economy. Inflation is like a pebble tossed into a pond. Its impact ripples outward, affecting every corner of the economy. One of the most immediate effects is on interest rates. When inflation is high, the Federal Reserve typically raises interest rates to cool the economy. Higher interest rates make it more expensive for businesses to borrow money, slowing down economic growth. For savers, higher interest rates mean more interest on deposits, but for borrowers, it means more expensive mortgages, car loans, and credit card debt. Inflation also impacts the job market, as businesses may raise wages to attract and retain employees. The stock market is sensitive to inflation. Low and stable inflation allows businesses to plan and invest, driving economic growth. High and unpredictable inflation can lead to stock market volatility and decline. For investors, inflation presents a unique challenge. The goal of investing is to grow your money over time. But inflation eats away at the purchasing power of your savings. Imagine you invest $10,000 in a bond that pays a 2% annual interest rate. If inflation is running at 3%, your real return is actually -1%. This is why it's crucial for investors to consider inflation when making investment decisions. Simply chasing high returns isn't enough. You need to ensure those returns outpace inflation. Stocks are often seen as a hedge against inflation because companies can raise prices to offset rising costs. Bonds tend to perform poorly during high inflation because fixed interest payments lose value. Real-world reality check inflation in action. Imagine you're saving for a down payment on a house. You've diligently saved $50,000, but inflation is running at 5%. The purchasing power of your savings decreases by $2,500 each year. If the house you're eyeing costs $250,000 today, it could climb to $312,500 in 5 years. This example illustrates the insidious nature of inflation. It's crucial to factor inflation into your calculations and make investment decisions that will help you stay ahead. Inflation-proofing your investments strategies for success. How can investors protect their portfolios from inflation? Focus on investments that have historically outperformed during inflationary periods. One option is to invest in stocks, as companies can often raise prices to pass on rising costs to consumers. Look for companies with strong brand recognition, a history of innovation, and a loyal customer base. Another option is to invest in real assets, such as real estate, commodities, and precious metals. Real estate can be a good hedge against inflation because rents and property values tend to rise with the general price level. Commodities, such as oil, gold, and agricultural products, can also provide a hedge against inflation. Finally, stay diversified. Spread your investments across different asset classes to mitigate risk. This will help ensure your portfolio is well positioned to weather any economic storm, including inflation. Navigating the inflation storm. A final word. Inflation is a fact of life. By understanding the dynamics of inflation and making informed investment decisions, you can protect your portfolio and achieve your financial goals. Remember to stay informed, stay diversified, and stay invested. The market rewards those who stay the course.